A discretionary loan trust is where you, known as the settlor, make a cash loan to trustees who then invest the funds in an investment, most often an insurance bond. The main benefit of the loan trust is that it allows you to have access to the amount that you've lent, with any future investment growth falling outside of your estate for inheritance tax purposes. Another benefit when it comes to inheritance tax planning is that because you have made a cash loan, there's no transfer of value like there would be for a gift for inheritance tax purposes. If you're unsure about the meanings of terms like settlor, check out my beginner's guide to trusts video. So let's look in more depth at how discretionary loan trusts work and why they might work for yourself. As the settlor, you're still entitled to the full amount that you've loaned into the trust, as I already explained. There are no rules under the terms of the trust on how much you can take and when you must take it. You can decide for yourself when you would like loan repayments to be made back to you. If your trustees have decided to invest the cash into an investment bond, this means they have flexibility when making loan repayments back to you. In other words, the trustees can take advantage of the cumulative annual 5% allowance and make loan repayments when you need the funds. The cumulative annual 5% allowance is where up to 5% of the amount invested in the bond can be withdrawn each policy year without creating a chargeable event, which might result in a tax charge of 10 to 20% depending on your income tax band. It's really important that the trustees keep a detailed record of any repayments back to you, obviously as the settlor, and ensure no investment growth is paid to you either. Another occasion where a discretionary loan trust is really flexible is if you decide that you no longer want to receive repayments but wish to make a gift instead. You can waive your right to any outstanding loan. Be aware, however, that this will give rise to a chargeable lifetime transfer for inheritance tax purposes, so it's imperative that you take account of all chargeable lifetime transfers you've already made in the 7 years before deciding to waive the loan. Otherwise, lifetime inheritance tax could be due. What's more, if you do decide to use the money in your discretionary loan trust to make a gift, on your death, any outstanding loan would be included as an asset in your estate, just like any other loan. This makes it really important for you to consider what you would like to have happen to any outstanding loan on your death. For example, do you want the beneficiaries of the loan trust to benefit or someone else? The inheritance tax implications will be different for different scenarios, so you'll need to make provision for this in your will. Let's assume that you want your trust beneficiaries to benefit from any outstanding loan due to you on your death. This is treated as a chargeable transfer and would use up some or all of your available nil rate band depending on the value of the outstanding loan. On the other hand, if you don't make provision in your will for who is to receive the outstanding loan, it becomes a little bit more complicated. Normal practice is that any outstanding loan will become part of your residual estate and should be repaid and distributed in accordance with the terms of your will. This is likely to mean that the trustees have to surrender bond segments or the whole bond to repay the outstanding loan, which would usually give rise to income tax on any chargeable event gain. If the bond surrender takes place in the same tax year as your death, the chargeable gain will be assessed in that tax year. But if the bond is encashed in a later tax year, any income tax liability would usually fall on the trustees. The tax rate payable depends upon the type of income and the amount received. Trustees have a standard rate band of £1,000, which means the first £1,000 of income received is taxed at 7.5%. If it's dividend type income or 20% for all other types of income. This assumes that you, as the settlor, have only established one discretionary trust. If you have more than one, then the £1,000 standard rate band is divided between the trusts. So if you've got 5 trusts, each one of them is going to have a £200 standard rate band. For trust income over £1,000, the tax rates jump up to 37.1% for dividend income and 45% for all other income. This is getting into a complex topic, and it's quite complex already, so I would suggest seeking professional advice if you're considering setting up a discretionary loan trust. Thanks for watching. I hope you've enjoyed this video and it's been useful to you. If you has, please press the like button now. My name's Justin King. I'm a chartered and certified financial planner. My aim is to help you live a successful life, and that often involves understanding your money. I host a podcast called the Retirement Cafe Podcast. You might like to tune into that. Check out the description below where you'll put a link in so you can go and take a listen. And of course, you can sign up for my weekly newsletter, which is packed with inspiration and tips for a successful retirement. For now, I'm Justin King, helping you live your best life.